Farmers, what if I told you there's a way you can sell your equipment or your land when you're ready to retire without getting a big tax bill and while creating retirement income for yourself? It's called a charitable remainder trust, and it's an instrument we use with quite a bit of frequency for retiring farmers. Watch this video to learn more. Welcome to Farm Lawyer. I'm Jason Wagner, and I help farmers, landowners, and rural families protect their land, secure their legacy, and plan for the future. Whether it's creating an estate plan, setting up the farm succession plan, or structuring your business, I'm here to guide you through the decisions that matter most. If you're ready to plan smarter and protect what you've built, let's get started. Today we're going to talk about charitable remainder trusts. It is January. Some farmers are looking ahead to the next year, wondering if this might be their last year of farming. But what happens when they're done farming, right? We have last year's grain or milk checks that were deferred into this year. That means they've got income that they've earned or would have earned last year that they're going to hit on their tax return this year. If they're not going to be farming next year, that means that they're also not going to be having to input costs. They're not going to have seed or fertilizer, those write-offs that we get at the end of the year. Of course, they won't be buying new equipment. They won't have a need for it. And we have this year's crop that they'll also have. Now, of course, they can defer some of that into the following year or store it for a number of years. But, what happens here is we kind of hit a little bit of a cliff because we have a farmer that has a bunch of grain that now they have to sell, and they don't have anything to write off against it or very little to write off against it. And it all gets piled up and it hits that tax return in 1 or 2 years, and it can cause a pretty substantial income tax bill at a time when, we're thinking about what we want to set aside to retire. And then you talk to that farmer about what they're going to do with their machinery and equipment, and they're not very excited about the prospect of selling it because they know that's going to come with a big tax bill too. What do we do? Well, first option, of course, is bite the bullet, pay the tax bill. It's worth exploring what we have beyond that. Second is you could potentially store that grain for a number of years. You run the risk of spoilage or, the commodity prices. There's different things that we have to take into account there. Maybe you're planning on renting out the bins next year. Well, you're not going to be able to rent them out if they're filled with your grain. So you could be potentially giving up a different income opportunity by keeping that grain in storage. Or if you're having to store it somewhere else, it's going to cost you, quite a bit to keep it there for a number of years while you wait to sell it. So a third option that I think is always worth exploring is called a charitable remainder trust. And we should think about this like your very own privately funded, privately created retirement plan, because that's how I like to use it. So the idea would be that the farmer would establish this charitable remainder trust. The farmer would contribute machinery and equipment into this trust, and then the trust would sell the equipment and conduct the machinery auction. Now, who is the trust? Well, you created the trust, so you're the grantor of the trust. You can be the trustee of the trust. You can also designate what's called an independent special trustee. It can be a friend or a neighbor. I have farmers that, it's kind of like they ping pong off of each other, right? So this farmer knows this farmer's doing it, and I'll do it for you, you do it for me. The big idea is that we need to make sure that we have an independent trustee so that we can prove that it wasn't a fixed deal, that somebody that doesn't have a financial interest in the outcome of the trust sold that property for fair market value. They marketed it, they found a buyer that's willing to pay the best price, they got fair market value. And if you're doing it at auction, that's a pretty good way to get the fair market value. So once the property is sold, the proceeds go into the charitable remainder trust. Okay, well, now what? Well, that trust will then pay the grantor, the farmer, an income stream. And that income stream could be for the rest of their life. It could also be for the life of the farmer and the farmer's spouse, so that if one of them dies, the income stream keeps going for the rest of the surviving spouse's life. There are other ways that you can structure it. You can do up to a maximum of 20 years. We had one recently that was set up for 10 years. So there's some things that you can do to kind of adjust, what you're looking to get out of it, how quickly you want to pull income out of it, how much certainty you want out of it. With the lifetime annuity, the nice thing is that it will always be there, right? If it's invested properly, versus with a 20-year term, if you outlive the term, well, you better have other sources to fund your retirement. But what did we gain when the trust sold the machinery and equipment? Well, the farmer did not recognize any of the sale in his income tax return because he didn't sell it. The trust sold it. So if we have $1 million line of equipment, that farmer has not recognized $1 million of income. So that keeps him out of the highest tax rates. That preserves the principal of the trust, of the machinery in the trust. So the full $1 million is available to invest versus half of it if it had been sold and we pay taxes. So now we've got it in the trust, it's invested, and then we get a rate of withdrawal out of that trust. And that is, that rate of withdrawal varies based off of the term that we choose and potentially your life expectancy or your age if we choose the full lifetime option. So we've got that now invested, but we've also got the funds coming out. And sure, you may not have gotten that big check at the end of the auction, but what you're getting is that income stream, and that income stream is going to keep coming year after year after year. When you add it all up with the returns you're going to get because you're investing a larger amount of money, that farmer is going to come out more often than not much further ahead by getting funds out of the charitable remainder trust than if he had just sold it and paid the taxes up front. So when you look at it that way, it's a pretty good deal. But, and here's the best part, is the residual that's left in that trust after the term or after the lifetime goes to a charity that the farmer chooses. And that's, in my view, a pretty good way to do things, because we're saving ourselves from that big tax bill. We're getting more income from the investment over time, and we're doing good for society in something that we get to choose where it goes. It could be a college. It could be FFA. It could be your local 4-H chapter. It could be your church. As long as it qualifies as a charity, you can choose that. We can also redesignate that charity as we go if it's structured properly. We've used this for machinery and equipment. It's pretty frequent just because if it's not sold, what are you going to do with it? Well, it's just going to sit there, right? It's going to sit there and depreciate, and it's going to break down. And okay, congratulations, you didn't pay the tax, but you also let this asset depreciate to nothing. So it's even worse. Nobody got the benefit out of it then. So we don't like that. We also use it for grain. So we think about that last year, that pile of grain that's sitting there, that final year's crop. Well, let's put that in the charitable remainder trust. Again, we don't have anything to offset against it, so a lot of it's going to be taxable compared to what we've been paying in the past. We've also done it for land. It's a little less common in my practice that we use it for land, typically because the farmer intends to keep the land, but I have used it for land a couple of times. So this would be same principle. We contribute the land to the charitable remainder trust. We've had auctions, we've had it listed, any way we go. But so we've got the land now in the trust, we sell it, same thing. Now we've got this fund, this proceeds that get invested. And the nice thing with land, typically, unlike with the machinery and grain, land has basis in it, which means what you paid for it. So you're going to get a charitable deduction as well. And if you've got other income, or you could use that charitable deduction to offset your grain income, it can be a good way to, again, just work that into the mix of the tools you use when you're ready to retire. So a charitable remainder trust can be a great option for a retiring farmer to look at, especially if they're thinking of selling their line of equipment or if they're going to have a big tax bill. And we have to make sure that we're considering all of the options. What is the term that we want for the rate of withdrawal? Do you want this over 10 years, 20 years? Do you want it the rest of your life? Who are the charitable beneficiaries going to be at the end? And who the independent special trustee would be to help you make the sales. So if you're considering a charitable remainder trust as part of your farm succession plan or farm retirement, please give us a call or check out our website, wagnerlegalmn.com or farmlawyer.com. And don't forget to like, subscribe, drop your questions in the comments, and like to hear from you. Thanks.